Welcome to the deep dive. Today, we're taking a closer look at something really fascinating. The S&P Global Flash PMI data for July 2025. Now, this isn't just, dry economic numbers.
Not at all.
It's more like a real-time window into the health of the world's major economies. It offers crucial insights, frankly, for anyone trying to understand what's really driving global finance right now.
Absolutely.
Our mission for this deep dive is basically to cut through the noise, pulling out the most important nuggets of knowledge to get you quickly and thoroughly informed.
And what really stands out from this data, I think, is the compelling story it tells. It's about a rapidly diverging global economy.
Diverging? How so?
Well, you'll see a clear split,
Yeah.
especially between the U.S. and, well, much of the rest of the developed world.
Okay.
And all this is happening while grappling with some surprisingly stubborn inflation.
Right. Stubborn inflation is definitely a theme.
And this divergence, it sets the stage for very different approaches from central banks in the coming months.
So policy divergence, too.
Exactly. And that, for you, has major implications across nearly every market out there.
Okay, let's unpack this then. Because the executive summary, it points to a growing and, like you said, frankly, alarming divergence in economic trajectories.
It is alarming, yeah.
So when we talk about this two-speed economy, especially concerning the U.S., what's the big picture? How does it stack up against, say, other regions?
So there are really two big takeaways from this data.
Okay.
First, that seeming strength in the U.S. economy.
Yeah.
It's actually quite narrow, potentially fragile even.
Fragile? How?
It's heavily reliant on the services sector, the part focused on the domestic market. That's growing robustly.
Right.
However, the manufacturing sector, which is usually a key indicator for long-term economic health,
Usually is, yes.
it's actually weakening. And get this, the data links this weakness directly to recent trade policies.
You mean the tariffs?
Specifically tariffs, yeah.
Yeah.
That's the first point. Second, inflation. It's re-accelerating
Oh, great.
and becoming stubbornly ingrained, particularly in the U.S. and the U.K.,
And driven by?
driven by those very same tariffs and critically tight labor markets.
So a double whammy there.
Pretty much.
Yeah.
This combination of uneven growth and persistent inflation creates a really challenging environment for central banks, especially the U.S. Federal Reserve, the Fed.
I can imagine.
In contrast, you look at the Eurozone and the U.K., they're showing only fragile, slow signs of recovery.
Just tentative steps.
Very tentative.
Oh.
Well, Japan's economy is surprisingly being pulled down by a renewed manufacturing recession.
A manufacturing recession in Japan, too. Wow. Okay, that's a fascinating split. But if the U.S. services sector is so resilient, why is the manufacturing weakness such a critical concern?
That's an excellent question.
Couldn't services just carry the U.S. economy, or are there, hidden dependencies we're not seeing yet?
Well, while services are robust right now, manufacturing often acts as a leading indicator for broader economic health.
Like the canary in the coal mine, sort of.
Right.
Sort of, yeah. It reflects global demand, supply chain stability, capital investment, things like that.
Okay.
When manufacturing falters, it can signal a slowdown that eventually ripples through other sectors.
Right, it doesn't stay isolated.
Exactly. Think of it like a chain. If one strong link is pulling a lot of weight, but the links behind it are weakening, well, how long can that last?
Good point.
Which makes the specific PMI numbers really crucial to examine.
Okay, so to truly grasp this divergence, let's look at what the actual July PMI numbers revealed for each major region. Walk us through the key figures that really paint this picture.
Absolutely. Let's break down the core data points, focusing on what they actually mean for you.
Great, let's start with the U.S.
Okay, for the United States, the composite PMI. That's the overall snapshot, right?
Right, manufacturing and services combined.
It hit a 7-month high at 54.6. Now, anything above 50 signals expansion, so that sounds good on the surface.
Oh, pretty good, yeah.
But dig a little deeper, and you see this was primarily driven by a surging services PMI at 55.2. Okay, so services are strong.
Very strong. While the manufacturing PMI actually slipped into contraction territory, it fell below 50 to 49.5.
Ouch. Below 50 is contraction.
Correct. And crucially, price pressures intensified sharply. Output price inflation was among the highest in 3 years.
And linked to.
Directly linked, according to the report, to those tariffs and rising wage costs.
Okay, so U.S. strong services, weak manufacturing, high inflation. Got it. What about the Eurozone?
In the Eurozone, the composite PMI rose to an 11-month high of 51.4.
Okay, still expansion, but lower than the U.S.
Lower, yes, indicating a modest, but importantly, a more balanced recovery. Services grew slightly faster at 51.2 compared to a negligible expansion in manufacturing output at 50.7.
So manufacturing isn't contracting there.
Just barely expanding in output terms. The overall manufacturing PMI was still just below expansion at 49.8. But here's the key difference from the U.S.
Inflation.
Exactly. Inflationary pressures remained mild. The PMI price indicators were aligning nicely with the European central banks, the ECB's 2% target.
Interesting. Very different inflation picture.
Very different. Now, the United Kingdom.
Okay, what's happening there?
The U.K. saw its composite PMI slow to 51.0. That suggests pretty stagnant growth.
Barely growing.
Roughly equivalent to just 0.1% quarterly GDP growth.
Yeah.
Services growth also slowed, down to 51.2, while manufacturing was stable but still clearly in contraction at 48.2.
Still stuck below 50.
Yeah. And a major concern here is a renewed rise in input cost and selling price inflation.
Inflation picking up again.
Yes, and the report attributes this to recent government budget measures, higher wages, national insurance contributions, plus a noticeable drop in new orders. It's a bit of a tricky spot for the UK.
Sounds like stagflation creeping in.
That's certainly the risk. Finally, Japan.
Okay.
Japan's composite PMI held steady at 51.5. Seems okay, right?
It looks stable.
But this figure actually hides a sharp divergence. Services activity reached a 5-month high at 53.5, which is strong.
Strong services there, too.
But unexpectedly, the manufacturing PMI dropped sharply back into contraction, down to 48.8.
Wow, another manufacturing dip.
And business confidence significantly weakened, mainly due to growing concerns about U.S. trade tariffs again.
So those tariffs are really casting a long shadow.
They certainly seem to be, based on this data.
Given these stark differences, really different pictures across regions,
Yeah.
the immediate question for many of our listeners is, how did markets react? What happened right after this PMI data dropped?
Yeah, the immediate market response was pretty significant. It was basically a repricing of monetary policy expectations.
The central bank expectations game.
Exactly. And it really solidified the U.S. dollar's position. Initially, the market had a bit of a risk-off reaction, nervousness.
Yeah.
Because of the weak manufacturing data globally.
Right, the bad news first.
But that quickly reversed. As the strong U.S. services and, importantly, the inflation components took center stage, the market essentially repriced towards a more hawkish Federal Reserve compared to other central banks.
Hawkish meaning tougher on inflation, maybe higher rates for longer.
Precisely. Signaling a tougher stance, likely keeping rates higher for longer, maybe even considering another hike down the line.
Okay, so how did that play out in specific markets? Stocks?
Well, on the stock front, U.S. equity markets opened mixed. The tech-heavy NASDAQ, surprisingly, found support from some strong earnings reports that came out around the same time.
Tech holding up.
Yeah, but the Dow Jones, which has more industrial companies, actually fell. That reflects that industrial sector weakness we just discussed.
Makes sense. What about bonds?
For bonds, U.S. 10-year Treasury yields rose. They climbed above the 4.40% mark.
Yields up.
Yields up. The strong services and inflation data effectively overshadowed the manufacturing dip. It signaled to bond traders that the U.S. economy is resilient enough to withstand and likely require higher interest rates for longer.
So the bond market bought the higher for longer story.
It seems so. And in foreign exchange.
The dollar.
The U.S. dollar index, the DXY, which measures the dollar against a basket of other major currencies, recovered strongly. Traders factored in this policy divergence we've been talking about.
So the dollar got stronger.
Significantly. The euro and British pound weakened against the USD right after the data release. This clearly shows the market is prioritizing those immediate inflation threats in the U.S. over concerns about future growth risks elsewhere.
That's a pretty powerful immediate reaction, but the impact often goes deeper, right? More than just those first hours.
Absolutely.
If we connect this to the bigger picture, what are the second and third order effects of a strengthening Fed stance amidst this global manufacturing slowdown? This sounds like it could create a significant ripple effect for you, our listener.
Yeah, this raises a really important question. What are the broader, more lasting implications?
Exactly.
Well, a more hawkish Fed in the context of a global manufacturing slowdown,
Yeah.
it will naturally tighten global financial conditions.
Okay, that's the second order effect, tighter money globally.
Right. So what happens then? Capital will flow towards the higher yielding, safer U.S. dollar.
Money chasing returns and safety. Yeah.
Exactly. Which effectively drains funds from riskier assets and emerging markets. Think about corporate profit margins, too, especially for manufacturers and multinational companies.
They get squeezed.
They'll face severe pressure from both sides. Higher input costs like those tariffs, and rising wages and slowing global demand. Companies are trying to pass higher costs to customers, right?
We hear that a lot.
But this becomes much harder as demand weakens globally.
Mm-hmm.
So those margins get really squeezed. It's like playing a game of hot potato where everyone's hands are tied and the potato just keeps getting hotter.
Not a fun game. And what's the third order effect from that? Where does that lead?
Well, these impacts can create a negative feedback loop. That's your third order effect.
A vicious cycle.
Potentially, yes. A stronger U.S. dollar exacerbates the global manufacturing downturn. Think about it. It makes USD price goods more expensive for everyone else.
Hurting demand for those goods.
And it makes U.S. exports less competitive, too. It also significantly tightens financial conditions for foreign debtors who borrowed in dollars.
Ah, the dollar debt problem.
Exactly. That could potentially trigger credit events in vulnerable emerging markets. Now, this global weakness could eventually spill over into the U.S. services sector itself.
So the U.S. isn't immune forever.
Probably not. It could erode that sole pillar of current U.S. strength. And that could potentially force the Fed to pivot, switch back to cutting rates, but maybe much later and perhaps more aggressively than anyone currently anticipates.
A delayed, sharp reaction.
Could be. Furthermore, look at the tariffs. There's a clear failure, based on this data, of tariffs to actually boost domestic manufacturing.
Right, manufacturing PMI is down.
Instead, they've arguably caused this inventory boom-bust cycle. First hoarding, now a slowdown. This could lead to policy unpredictability.
More uncertainty.
Yeah, the administration might potentially intensify disruptive trade measures if the current ones aren't working as intended. This whole situation is creating what some analysts are calling a dollar doom loop for the rest of the world.
A dollar doom loop. Explain that.
It's like a snowball rolling downhill. A stronger dollar makes U.S. goods pricier for others and makes it harder for countries with dollar-denominated debt to pay it back.
Okay.
This weakens their economies, which in turn makes the U.S. dollar look even stronger by comparison, perpetuating the cycle.
So the U.S. ends up looking strong relatively, even as it causes problems elsewhere.
Essentially, yes. The U.S. is effectively exporting inflation through higher import costs for others, and importing deflationary pressures via cheaper imports and weaker global demand. It creates a very unstable equilibrium.
Wow, that dollar doom loop concept is incredibly powerful. It almost feels counterintuitive, doesn't it? That tariffs meant to boost domestic manufacturing could end up causing this kind of global instability.
It does seem counterintuitive on the surface.
But couldn't one argue perhaps that a stronger dollar might eventually force other countries to, get their own houses in order, maybe leading to a more globally balanced recovery down the line? Or is that just wishful thinking given the pressures?
That's a fair challenge. I mean, in a perfect world, theoretically, a strong dollar could incentivize other nations to become more competitive or address their own structural issues.
Right. Create pressure for reform.
Perhaps. However, the immediate impact, as our sources here suggest, seems more disruptive than constructive. The problem is that this dollar doom loop creates a disequilibrium where the pressure is immense.
Okay.
And it's really hard for countries already struggling with high debt or weak growth to suddenly get their house in order when global financial conditions are tightening specifically because of that strengthening dollar. It's a very difficult balancing act for them.
Yeah, sounds incredibly tough. That's a fascinating perspective. It really sounds like the market's own beliefs can become a self-fulfilling prophecy here.
Absolutely.
This concept is often called reflexivity theory, right? Where market sentiment doesn't just reflect reality, it actively shapes it. What stands out to you in terms of how market psychology is shaping these dynamics right now?
Oh, reflexivity is definitely at play here. What's truly striking is how the market's growing conviction in U.S. exceptionalism.
That idea that the U.S. economy is just uniquely strong.
Exactly. That, combined with the belief in a higher-for-longer Fed policy, actually becomes a self-fulfilling prophecy.
How so?
Well, this expectation itself draws capital into the U.S., right?
Right.
Which strengthens the dollar and tightens global financial conditions.
Yeah.
This, in turn, weakens foreign economies, making the U.S. appear relatively stronger,
Right.
thereby validating that initial belief.
Ah, I see. The belief creates the conditions that confirm the belief.
It's a classic reflexive loop.
Okay.
And simultaneously, we're seeing those common business comments in the PMI reports about passing tariff-related costs to consumers.
Yeah, passing the buck.
This isn't just a cost, it's actively shaping inflation expectations. When businesses and consumers expect higher prices, they change their behavior.
Like buying sooner, demanding higher wages.
Precisely,
Yeah.
which actually does increase inflation.
Yeah.
This then forces the Fed to validate the market's hawkish expectations by keeping rates high.
So expectations drive reality, which forces the Fed's hand.
You got it. And the tariff policy itself is another powerful reflexive loop. Remember the inventory buildup?
Yeah, the hoarding before tariffs hit.
The expectation of tariffs actually caused a boom in manufacturing through that inventory hoarding. But now, the implementation of tariffs is causing a manufacturing bust as that artificial demand evaporates.
Boom and bust.
And markets' reaction to this bust, fearing a slowdown, could then lead businesses to cut investment further, deepening the manufacturing recession beyond what the initial shock might have caused.
Wow. So how is all this affecting overall market mood? Is it risk on, risk off?
It's actually fragmenting market sentiment rather than clearly pushing it one way or the other.
Fragmenting.
Yeah, it reinforces that dominant narrative of U.S. exceptionalism, which is generally positive for the U.S. dollar and maybe U.S. tech stocks.
Okay.
However, it also strongly introduces a global stagflation narrative. Remember, weak global growth plus persistent inflation.
Right, the nasty combo.
And that's negative for cyclical stocks, commodities, and pro-cyclical currencies, like the Aussie dollar.
So selective winners and losers.
Exactly. Interestingly, the VIX volatility index was stable or even falling slightly around this time.
The fear gauge wasn't spiking?
No, suggesting the market isn't pricing a systemic panic, but rather a rotation between sectors. And look at gold, a traditional safe haven.
What did it do?
It actually fell as the dollar strengthened.
Huh. That's unusual for risk off.
It indicates this isn't a pure flight to safety, but rather a flight to the higher-yielding U.S. dollar. The dollar is king right now.
Okay, that makes sense. Flight to yield, not just safety. For those of our listeners who are keen on foreign exchange, which currency pairs are identified as being most strongly affected by this economic divergence and policy outlook?
Right, focusing on FX. Based on this analysis of economic and policy divergence, several key currency pairs really stand out as most impacted.
Which one should we watch?
First, USD. This is basically the primary battleground for this whole divergence story.
The big one.
Definitely. Strong U.S. services and inflation data starkly contrast with the Eurozone's modest recovery and its on-target inflation.
Big difference there.
Huge. This reinforces the policy divergence between a hawkish Fed and a neutral to dovish ECB. So the fundamental backdrop looks negative for the euro against the U.S. dollar.
Okay, USD under pressure. What else?
GBP-USD. The British pound versus the dollar. This pair is highly sensitive to that stagflation theme we mentioned.
Because the UK seems particularly stuck.
Exactly. The UK's PMI data really reflects the worst of both worlds. Stagnant growth and re-accelerating inflation. This puts the Bank of England, the BOE, in an incredibly difficult position.
Tough choices for them.
Very tough. It increases the risk of policy missteps, making the pound particularly vulnerable, especially against a hawkish Fed.
Okay, GBP-USD also looks weak. Next.
USD-JPY, dollar-yen. This pair is largely driven by widening interest rate differentials.
The difference in interest rates between the U.S. and Japan.
Correct. Strong U.S. data pushes U.S. yield higher, while Japan's weakening manufacturing and easing domestic inflation just reinforce the Bank of Japan's, the BOJ's ultra-dovish stance. They're keeping rates super low.
So the gap widens.
Right. And the main dynamic here is the carry trade, basically borrowing in low-yield Japanese yen to invest in higher-yield U.S. dollars.
Making money on the interest rate difference.
You got it. And that's positive for USD-JPY, pushes the dollar higher against the yen.
Makes sense. Any others?
Yeah, the commodity currencies, IUD-USD and NZD-USD. The Aussie and Kiwi dollars against the U.S. dollar.
What drives them?
They're often seen as proxies for global growth and overall risk sentiment. Weak global manufacturing data, particularly those drops in the U.S. and Japan.
Signals trouble for commodities.
Exactly. Plus ongoing concerns about China's economy. It all signals reduced demand for industrial commodities. This, combined with a broader risk-off sentiment towards the global industrial cycle and a strengthening U.S. dollar, well, it creates a negative fundamental outlook for these pairs.
So commodity currencies likely under pressure, too.
That's the takeaway, yes.
So we've got a lot of moving parts here. Divergence, inflation, policy expectations, market psychology. What are the most likely paths forward, given all this information? The analysis outlines 3 potential scenarios, I believe.
That's right. We've built 3 likely scenarios based on this multidimensional analysis, trying to weigh all the various forces at play.
Okay, lay them out for us. Scenario 1.
Scenario 1, bullish USD U.S. exceptionalism and persistent inflation. This is the one we see as most probable, coming in at around 55% likelihood.
Okay, the base case. What's the argument?
The core argument is that the resilience of the U.S. services sector proves sustainable. It's supported by a strong labor market, solid consumer balance sheets.
The consumer keeps spending.
Basically. Meanwhile, inflation, driven by those tariffs and wages, remains stubbornly above the Fed's target,
Keeping the Fed hawkish.
forcing the FOMC, that's the Federal Open Market Committee, the Fed's policy-making arm, to maintain a restrictive stance and push any thoughts of rate cuts well into 2026.
Wow, 2026.
That's the idea in this scenario. Meanwhile, Europe and Japan continue to stagnate under weak global demand and their own structural issues. This just widens that policy and growth divergence.
And the chain reaction.
Strong U.S. services PMI leads to persistent U.S. wage and price pressures, leads to a hawkish Fed keeping rates high, leads to the market completely removing remaining 2025 rate cut expectations. U.S. yields stay high.
And capital flows into the dollar.
Strongly, causing the euro, British pound, and Japanese yen to weaken significantly. For currency pairs, this means euro USD could break lower, maybe towards 1.1350, and USD JPY could break higher, possibly above 150.00.
And the time frame for this?
This is viewed as a medium-term scenario, looking at maybe 1 to 4 months.
Okay, that's scenario 1. What's scenario 2?
Scenario 2, bearish USD, global contagion, and U.S. hard landing. This has an estimated probability of 30%.
Less likely, but still significant. What's the story here?
The core argument here is that the weakness in U.S. manufacturing doesn't stay isolated. It proves to be a leading indicator.
The canary really was singing.
Exactly. A strong dollar and tightening global financial conditions cause a sharp global slowdown, which then infects the U.S. services sector itself. Through lower export demand, reduced corporate profits, widespread layoffs, ultimately cracking U.S. consumer strength.
So the U.S. can't escape the global slowdown.
Not in this scenario. And the Fed, it's then forced to pivot dovish very quickly, cutting rates sooner and maybe faster than expected.
A big U-turn.
Right. The causal chain would be deeper U.S. manufacturing PMI contraction, further global PMI weakening, lower U.S. corporate profits, a sharp rise in U.S. jobless claims, U.S. services PMI falling below 50.
The warning signs flashing red.
Then the Fed signals imminent rate cuts, U.S. yields collapse, and the U.S. dollar sells off sharply.
So currencies would reverse.
In this scenario, yes.
Yeah.
The euro could rally back strongly against the dollar, maybe towards 1.1830, and USD JPY would drop significantly, perhaps towards 142.00.
Time frame for this possibility.
Also medium term, but maybe slightly longer, say 2 to 5 months for this to play out.
Okay. And the third scenario?
Scenario 3. Sideways complex policy stalemate and conflicting data. This is seen as the least likely, maybe 15%.
The muddle-through case.
Sort of. The core argument is that economic data just remains contradictory and unclear. The U.S. economy continues its two-speed operation services. Okay. Manufacturing weak, preventing a clear trend from emerging.
Stuck in limbo.
Pretty much. Inflation might ease slightly, but stays too high for the Fed to get comfortably, while growth isn't weak enough to make them panic. Other central banks remain paralyzed by their own stagflationary issues.
So everyone's stuck.
Yeah, and the market gets pulled around by conflicting data points, maybe geopolitical news on tariffs, leading to range-bound but volatile trading.
Choppy waters.
Exactly. In this case, we'd see major currency pairs like USD trading without a clear direction, but maybe in a wide, choppy range.
Time frame.
This feels more short to medium term, maybe 1 to 3 months of this kind of frustrating action.
Okay, so given those three scenarios, the analysis points pretty clearly towards scenario 1, U.S. exceptionalism and persistent inflation as the most probable outcome.
That's right, at 55% probability.
So what does that mean for a strategic approach? What are the key takeaways for our listeners looking at the markets right now?
Okay, so if we accept scenario 1 as the most likely path forward, and the analysis suggests we should.
Based on the current momentum.
Right, the underlying momentum in the U.S. services sector, driven by that tight labor market and sustained wage growth, it's a powerful force. And more critically, the inflationary impulse.
From domestic strength and tariffs.
Exactly, it's undeniable, and it creates a very high bar for the Fed to pivot dovish, to start using policy. Plus, the weakness in other economies is already evident.
Making the U.S. look stronger relatively.
Which makes the path of least resistance a stronger U.S. dollar, driven by those widening yield differentials we talked about.
Okay, so how does that translate into action, or at least thinking about action?
Well, let's put some current context on it for you. The Fed is currently maintaining that hawkish stance, right? Inflation's still above their target. Market pricing clearly reflects this. It shows fewer and later rate cuts from the Fed compared to other major central banks. For instance, the market sees only a minimal chance for a Fed cut in July. The bulk of any cuts are now pushed into late 2025 or even 2026.
That far out.
Contrast that with the ECB, the European Central Bank. They're taking a very data-dependent approach, and the market is pricing a reasonable chance of a September cut.
Sooner than the Fed.
Potentially, and the Bank of England. They've already cut recently, but remain vigilant on inflation, with further cuts expected later this year.
Also ahead of the Fed's likely timeline.
It seems that way. So for strategic advice, a trading strategy should really focus on leveraging this anticipated U.S. dollar strength.
How would one do that?
Our primary recommendation based on this analysis is to establish core, long U.S. dollar positions. That means betting on the dollar strengthening.
Against which currencies?
Against currencies with more dovish central banks, those more likely to cut rates, and/or those with weak underlying economies.
Like the euro.
Specifically, yes. Consider selling the euro against the U.S. dollar, selling your USD. Look for opportunities when the euro rallies temporarily because the fundamental backdrop strongly favors U.S. dollar strength. A key target might be the 1.1445-1.1556 support zone. A sustained break below there could open the door for deeper declines.
Okay, sell USD on rallies. Anything else?
Also, buying the U.S. dollar against the Japanese yen, buying USD-JPY, this offers a favorable risk-reward, particularly because of that carry trade potential earning the interest rate difference. A break above recent highs near 149.60, 150.00 would be a strong bullish signal.
Got it. Any tactical trades?
As a secondary, maybe more tactical trade, you could consider selling the British pound against a more resilient currency like the euro. So buying U or UBP.
Why that specific cross?
It isolates the UK's acute stagflation risks, that tough combination of stagnant growth and rising inflation, from the broader U.S. dollar trend. You're betting on the UK underperforming even the Eurozone.
Interesting angle. Any key levels to watch?
Yeah, keep an eye on that recent monthly low for USD around 1.1556. And for the U.S. dollar overall, watch the DXY index. A break and hold above the 98.00 level would confirm widespread dollar strength.
Okay, very clear takeaways there. So what you've heard today is really a detailed look at how this global economic divergence and persistent inflation are truly shaping the future of financial markets, particularly through the lens of currency movements.
It's definitely a complex picture.
It is complex, but understanding these core dynamics, these forces at play, can give you a real edge in making sense of the headlines and what's driving the markets.
And maybe this raises an important question for you, the listener, to consider.
Go on.
If tariffs are clearly failing to stimulate domestic manufacturing, as the data suggests, and are instead contributing to inflation and global instability, what unexpected policy shifts or market reactions might we see next?
Good question. What if policymakers change course?
Exactly. The current equilibrium feels unstable. Understanding the potential for that dollar doom loop to truly intensify, or perhaps for something to break that loop, that seems critical going forward.
A lot to think about there. We hope this deep dive has given you a clearer understanding of these critical economic forces. Keep thinking, keep questioning.
Stay curious.
And join us next time for another deep dive into what matters most.